Hey everybody, Logan Alex, CPA here. I own Choice Tax Relief, where we help taxpayers deal with the IRS, fight the IRS. We reach the best resolutions possible for our clients. And today, as the owner of a tax relief company who has talked to hundreds of people who have tax problems and who employs staff who have talked to hundreds of people. Probably some of them have talked to thousands of people who have IRS back tax debt. I feel it is my obligation to share a hard truth with many of you folks out there who have found yourselves with back tax debt to the IRS. And the hard truth is this: despite what you may have heard on the radio, despite what you may have been told by a salesperson from a tax relief company or otherwise, despite what you may have seen in online advertising, the vast majority of folks who owe the IRS will not qualify for an offer in compromise. That's a settlement with the government to pay them less than you owe in terms of your back tax debt. I'm going to get into the reasons for that later in this video, but right now I want to say that is not necessarily a bad thing. As a matter of fact, there are other tax resolution options available to taxpayers who do not qualify for an offer in compromise that can be just as good or almost as good as an offer in compromise would be. What am I talking about? Well, a common resolution we get folks in who do not qualify for an offer in compromise is a hardship-based installment agreement or a partial payment installment agreement. Now, you may have been in an installment agreement with the IRS before on your back tax debt. And the installment agreement that you set up with the IRS, especially if you just set it up online, that is called a full payment installment agreement. Under that kind of installment agreement, you're going to pay the IRS everything you owe with penalties and interest over a certain span of time, generally over 72 months, or when the tax debt drops off at the CSED date, if that's before 72 months. However, there are special kind of installment agreements called partial payment installment agreements where, yes, you're going to have to pay the IRS monthly. It's not like with an offer in compromise where you're paying the full amount within 5 months, or in some cases within 24 months, right? You're still paying the IRS over a length of time, years and years and years, every month, directly debited out of your account. However, with a partial payment installment agreement, the sum of all those payments, by the time you've made them all, on the date your tax debt drops off, which is 10 years from the date of assessment, does not sum up to the total amount that you owe the IRS. So you are partially paying your liability to the IRS. Far more people qualify for a partial payment installment agreement than an offer in compromise, especially if they have equity in their home that they cannot access. Okay. Another solution, CNC, currently non-collectible status. This is where we make the argument to the IRS that, hey, this individual, they can't pay you anything every month, IRS. So they will not have to pay the IRS anything. Literally zero. With an offer in compromise, it's an offer. There has to be consideration. You have to offer at least something to the government when you make an offer in compromise. With CNC, you don't pay the government anything because you're considered not collectible. That's what it stands for, CNC, currently not collectible. Now, we typically only like to go down this path for folks who meet certain criteria. And the reason for that is the IRS does have the right to kick people out of CNC if they start making more money. Same thing with PPIAs. The IRS, they can review these every 2 years. But we personally find that the IRS tends to kick people out of PPIAs far less frequently than they kick people out of CNCs. And in fact, there's a kind of a systemic removal from CNC that happens based on your AGI on future tax returns. That's probably getting a little too technical, but for some folks, CNC is a great option, right? If they can stay in CNC until their tax debt drops off, great. Downside of PPIs and CNCs is the government will file a notice of federal tax lien against you to protect its interests. So those are two other options that we often look at for clients who don't qualify for an offer in compromise. But now let's circle back to why do most taxpayers, even if they owe the IRS a significant amount of money, not qualify for an offer in compromise? And that is because despite the way that the tax relief industry as a whole has made offers in compromise and settlements and fresh start programs sound, it really comes down to a formula. It comes down to a formula of how much disposable income you have every month. And that disposable income is not calculated how you would calculate it. It's calculated how the IRS calculates it, where they cap certain expenses, right? Let's say you live in a snazzy apartment and you're paying $5,000 a month as a single person, right? IRS is going to say, you don't need to pay $5,000 a month for an apartment. For your particular county and a household size of 1, we're going to cap all your living expenses, or your housing expenses rather, at say $2,000 a month. And they come out with these different standards every year for every county in the country. They do the same thing for other expenses. There's a national standard for food, clothing, and miscellaneous. Now, sometimes you can argue that, perhaps one of your children has a special dietary need and it's been medically documented that why you need to spend more on food every month than the IRS expects you to. You have to document all that. But in general, the IRS is going to cap you at certain levels of expenses for all of your basic living expenses. So, offer and compromise formula. Take your monthly disposable income, and then you have to multiply it by a certain multiplier. It's typically 12, could be 24, if you need more time to pay your offer amount. So, and that's part of what is called your reasonable collection potential. Okay, that monthly disposable income times a multiplier, which is typically 12, right? So, if your monthly disposable income per the IRS's math is $1,000, then you multiply that by 12. Okay, part of your RCP is $12,000. We're not done yet. Okay, we're not done yet, because the IRS also looks at your equity and assets, and they do not care if you cannot access the equity in your home. In reality, they will still count the equity in your home against you for purposes of offer and compromise. Now, they do give you a little haircut. You can take the fair market value, times it by 80%, subtract the mortgage, and that's the value for offer and compromise purposes. Sometimes you can get a better answer than that if you actually get a contractor out there, get an inspector out there, and you can document that, well, look at all these repairs this house needs. It's not fair to just look at Zillow and call that the fair market value. But regardless, if you have a ton of equity in your home, it's going to be a tough sell to qualify for an offer and compromise, whether you can get that access that equity and convert it to cash or not, right? They're going to look at the equity in all your assets. Sometimes they give you this 20% haircut where you multiply the fair market value by 80%. Sometimes you don't. But, stocks, IRAs, other investments you have, your home, right? Your cash, you have a lot of in savings accounts, CDs. They're going to look at all that, right? And they're going to consider all that fair game, that you should give that equity in your assets to them in your offer. Right, so if you have substantial equity in assets, including equity in your home, offer and compromise is probably off the table. And then you have to add these two, right? Remember that kind of 12,000 I told you about earlier in that example? That's one part of your reasonable collection potential, your RCP that you have to give the government an offer and compromise. You add that to your equity and assets. And those two figures combined is your RCP, your reasonable collection potential. This is what the IRS expects you to give them in an offer and compromise. And for most people, the sum of those things greatly exceeds the amount of their IRS debt, meaning the IRS will not accept that offer. And there's another nit here too, which is even if that RCP amount is lower than what you owe the government, if we isolate that monthly disposable income and multiply it by the number of months left until your tax debt drops off, the CSA date, 10 years after the date of assessment, if that amount is greater, if the government would get more in that installment agreement, even if it's a partial payment installment agreement, if the government would get more in that arrangement than in granting you an offer and compromise, they'll deny the offer and compromise is not in the best interest of the government and want to see you placed in an installment agreement. Now, on the flip side of all this, I will say that many offer examiners, the people who review your offers and compromise at the IRS, well, I shouldn't say many. Some of them have a chip on their shoulder. Right now, we're dealing with the case with an individual who has many. Well, first, let me say this individual makes over $200,000 a year. Okay. And this individual lives in one of the highest cost of living places in the nation. And he has many dependents, probably more dependents than anyone watching this right now. We're not just talking children, we're talking older parents and things like that who all live with him under his roof and who depend on his sole income to survive. Well, the offer examiner is not being very friendly. It seems she has a chip on her shoulder, right? Why doesn't want to grant an offer and compromise to a guy who makes a couple $100,000 a year because she just thinks, gosh, he makes a whole heck of a lot of money. He makes a heck of a lot more money than I do, and I've paid my taxes diligently. I'm a federal employee, right? So sometimes you get some of that, right, from the folks in the offer unit. And sometimes, in my opinion, they reject their offers and compromise, perfectly good offers and compromise we submit to them, just on that basis, kind of a personal vendetta or something like that. Thankfully though, the IRS has an office called the Independent Office of Appeals where you can, if you've just had a rotten offer examiner who is not really doing their job, who's not following the Internal Revenue Manual, who's not listening to your well-crafted arguments that are in the basis of the Internal Revenue Code or more likely the Internal Revenue Manual, then you have another bite at the apple in the IRS Independent Office of Appeals, where if we do run into one of these bad offer examiners, we do take our clients' cases to appeals, and we generally do win there. So, not to be a Debbie Downer about offers and compromise. Okay, I have some other videos here on the channel. You'll see them here on the left-hand side of the screen that goes more in depth about offers and compromise, the offer and compromise formula, how to get offers and compromise reviewed. But I feel like I just have to say this, folks, because I've seen a lot of bad marketing out there from folks who basically implying that, hey, anybody can qualify for an offer and compromise when that's just not the case. Again, my name is Logan Alec. I own Choice Tax Relief. Give us a call, 866-8000-TAX, if you want a free evaluation of your tax situation. Bye-bye.